So today my focus would be on stocks and probably the working capital as well, because that's the unrelated one. And then tomorrow we will be focusing on the other more a bit of more technical aspect on the debt financing and cost of capital and other things. So what happens is that when you are working, let's say you have started your own business, you are the 100% owner of the business, right? But you don't have any shares at the moment because you are just your own shop, and then you don't need money from outside. If you need money, you borrow, correct? Then that is the entry level of doing any kind of business, which is 100% ownership, your personal, and then that's the 100% shareholding, right? Now let's say that there is a partnership. When it comes to when you want to grow the business, you add one more partner into your business and say, okay, now we are doing a 50-50 partnership, let's grow our business, right? So they grow the business, then they are there two partners, and they own the company half. So there you become a kind of shareholder in the company, where you hold half 50% of the stake in the company, and another 50% is taken by somebody else. But you still only have a partnership agreement. You're not really issuing any kind of certificate that, oh, you own 50% of my company and you own 50% of my company. It's just a partnership agreement, right? To formalize this, when you want to add more partners, when you want to say, okay, we want to get the more and more investment into the business, you cannot work with the partnership agreements, right? So then, because it becomes impossible for you to create a new partnership agreement every time a new shareholder or a new investor incoming into the business. So the stocks basically helping the companies to solve two kind of problems. One is that it makes it easy for new persons to join in the company, right? If anybody want to invest, you just have to sell them the shares. You don't have to issue a new contract, new partnership, and sometimes you don't want them to invest. Sometimes you don't want them to manage the company, correct? So you're just saying, okay, you want to invest 10,000, you can buy only one share. So it serves three purposes. One is it makes it easy for raising capital. Second thing, it makes it easy for smaller investors to buy the companies. Like, let's you are now buying Apple shares or Google shares or Nike shares. It basically means you own the company to that certain percentage. But the only thing is that it's 1 in a million. You are a shareholder, you are the owner of the company, but not entire company, right? Your percentage is maybe 1 over 1 million. So you can calculate how many percent of the company you really own. So that is the easiness. So it makes it much more liquid and much more easier to invest into the company and become owner of the company, right? And the third thing it serves is, if it's listed on the stock exchange, people can buy and sell shares among each other. So they don't need to really inform the company who is the owner of the shareholder, because the company does not care about that anymore. Company cares that, okay, I have issued 10,000 shares in the public. Now they can be changing every time, and from one person to another person. They just need to register. Whoever wants to get the dividend, they need to register with the company so that they can get the dividend, they can get the information. That's the only thing company is caring about, but it gets money from those shareholders. So that is the history of share, how the shareholding starts. So the shareholding is, it was devised to help the companies with in the investors with these three basic things to solve their problems, right? One is the liquidity, another is the availability, and make it easy and convenient to buy and sell the shares of the companies. So that's the thing. Now the one that you see on the screen is, if you want to know, so this is a bit of more technical details on the stock market. Okay, so basically the shares can be listed and can be not listed. Now what is the meaning of shares to be listed and shares not to be listed, right? So shares which are listed means there is a stock exchange. What the company need to register themselves with that particular stock exchange if they want to sell their shares in an open market. So they have to register, they have to comply with certain requirements, and then the stock exchange will allow them to sell their shares on the to a general public, right? So there are two types of trading. One is primary trading, which means the investors are buying directly from the company. That happens only on the first time. The companies normally cannot issue the shares every now and then, right? They have to take the permission from the stock exchange. So there are two types of the shareholding, two types of stocks, basically, the way of issuing. One is stocks which are listed on a stock exchange. Another is unlisted. So basically it starts with unlisted. By default, any company who has issued a shares are unlisted. Unlisted means they are not registered on any stock exchange. If somebody want to buy the shares, they have to go to the company, and company will issue them the shares in physical form or in dematerialized form, and take the money directly and issue them, right? So that is their personal business. It's like tomorrow I run a company, somebody want to buy my shares, then I say, okay, this is the value of my share, you pay this amount, and then I will issue you one stock or two stock or whatever in the multiples. So normally there is a value of every stock. So what the company do is, let's say if I think my capital investment is $1 million, I will issue 1 million shares of $1 each. So the face value of the stock will become $1, but it will not be sell at $1 if I continue to do my business. If I continue to increase the business, make more money, and I have a goodwill, the demand for my stock will be very high in the market. So I don't have to sell at $1 anymore. If somebody pay 1.25, somebody say 1.5 or $2, I will sell to them, right? So that means I can charge a premium on that shares. So that is the unlisted. Only the problem with that is you cannot reach the masses. Only those who know you, they will be ready to buy from you, right? So now if let's say somebody else want to buy from him, if he think that the company's worth is more than $1 per share, he will be ready to spend more. If you don't think he don't want to spend more than $1, then he will not buy, right? But how will they determine? They don't know the profitability of the company. They don't know about much of the company, right? Because since it's private, it's unlisted, there is no obligation on the company to give every information to anybody else, right? If let's say you are buying only one share and you go to the company and say, I want to see your profit and loss statement because I want to buy one share, I want to make sure that my $1 is safe, the company will not show you. You buy or you don't buy is not their problem, right? But if you go and say, I want to invest $500,000 in your company, can you show me your profit and loss statement? Can you show me your operations? If the company is interested, they will show, right? If the company is not interested, they will not show. So this is how it works on an unlisted basis. It's a private equity, one-by-one transaction, one-on-one transaction. If let's say you already buy the shares of the company, now you want to sell back. So company will not buy back because companies are not allowed to buy back just like this. They may buy, but why they should buy back the shares once sold, right? So you only have a choice to find somebody else who want to buy the shares. But because it's not listed, because nobody have access to the financial records of the company, it will be very, very hard for that person to sell. So very few people will be interested in investing in unlisted stock. It's only the bigger investors who want to buy like 20% share, 30% share of the company itself, the entire company. They will only be interested, or the banks, financial institutions. Those are the people who want to invest, who are investing in the unlisted stock exchanges, unlisted companies. But so there are problems on the liquidity, there are problems on the negotiation, there is a problem on the information, right? To solve these problems, the governments, they came up with these stock exchanges. Say, okay, if the company want to sell their shares in the public at a large, because they want to also protect the public from the scam, they say that the companies has to register their shares on that particular stock exchange. Means that all the information the company will have to provide to the stock exchange. What is their profit and loss, what are their plans, what are their board meetings, who are their shareholders, who are their directors, every information to the stock exchange. How many shares they want to sell in the public. So that is the initial information they have to provide to the stock exchange. Now once the stock exchange has this information, they will put in their systems, and anybody who is a general public and investor who want to invest in the company, they don't need to ask the company anymore. They can go and look at the stock exchange and say, oh, this is the profit and loss statement of the company, these are the prospects, these are their plans, I'm interested or I'm not interested. Then if let's say they want to buy, the stock exchange knows who owns the company share. So if let's say you want to buy, they will put a request on the board that somebody want to buy one share, who want to sell. If nobody want to sell, you will not get the share. Maybe somebody else want to sell one share, so they may sell you their shareholding, and the stock exchange will just register that okay, now this stock is owned not by Umar but by Pushpika. If Pushpika want to sell, he will send information to the stock exchange, I want to sell my shares. Then somebody else who may want to buy, maybe he's an existing investor or maybe he's a new investor, he may approach the stock exchange that okay, I want to buy this share, right? And then he will buy the share and stock exchange will register okay, now this share is bought by this particular person. And at the end of certain dates, they will inform the company as well that hey, your share is now in the name of this particular person, otherwise the company won't even know. So this is how the overall stock exchange works. Now the price, how they determine the price? Well, the price is initially the face value, then it depends on the supply and demand, right? If a lot of people are asking for the stock, then the price will automatically increase, right? Because some people will say, oh, I want to buy. If nobody want to sell, there is no supply, then the price will increase because the peoples will offer more and more for owning the stock of this particular company. Just like Apple, you want to buy, if nobody is selling, you will be ready to offer extra money to own the share compared to the market price, and somebody who is in need, they will sell. So the price now will depend on the supply and demand in the market. So that's why we say in the market. But just to let you know, at any point of time, normally around 25 to 30% of the stocks are only available in the market. So it's not the entire company is being sold in the stock exchange, it's only a fraction of it, because the majority of the shareholders are still owned by few people, right? The maybe top 10 shareholders or top 50 shareholders, they are not selling their shares on the stock exchange because they want to run the company. It's only about 25 to 30% depending on the different companies. That's the shareholding which is being sold on the stock exchange. So if you buy every share on the stock exchange, you will still not be able to own the entire company, because all the shares are not available on the stock exchange to be sold. So that's how it works, the stock exchange, the pricing it works. The benefit it gives is it's easy for you to sell. Anytime you want to sell, you can sell. You want to sell partially, you want to sell your entire stock exchange, you can sell. You can demand your price that I want to sell only at this particular price, I will not sell any lower. So you don't have to deal one by one. Now, how do you deal with the stock exchange? The stock exchange is dealt to via the brokers. So there are nominated brokers on the stock exchange who work on behalf of stock exchange. So if you want to buy, you cannot just go and buy into the stock exchange and yell, I want to share, I want to sell. No, it's not like this, right? You have to have a broker, because they have appointed brokers on the stock exchange. So you have to contact the broker and say, okay, I want to sell this. The broker will put into the stock exchange, I want to sell, and the information will go to other brokers. Whoever want to buy among those brokers, they will buy among the brokers, right? So, and then there are registrars who are managing the stock shareholding of the companies, and then they will be able to buy or sell the shares. So on a typical stock exchange, as you will see on the screen, the price of the stock go up and down every single minute, every single second, depending on how much is the trading in the company, or how many people are really willing to buy and sell those shares, right? And then there is always some information, like it's not very clear, but there is a range of the company share, how much is the price ranging between, what is the 52 weeks range, what was the highest price, what was the lowest price, how much is the market capitalization, what was the opening price on the today, what is the average volume, what is the earning per share of the company, how many shares are outstanding in this case, and what are the other information. So beta and everything else we will look at separately. We will be covering that part in very soon. Then you have dividend yield, how much is the dividend yield. So these are the information which is generally available on the stock exchange, and they have a charts to tell you how the shares have behaved in last 3 months, last 6 months, last 1 year, last 3 years, or since the inception. So you can see really how the price has increased or decreased over a period of time, right? So that's the working of stock exchange, and that's how the companies issue the stocks. This is I just show you because you can see on the google.com/finance, you will be able to read the basic information here for a normal investor to understand is the price, the $60.39, right? How much is the price per share that is available in the market. Now plus 0.44 or 0.70% is the change from yesterday. What is the change from yesterday price? If it's in plus, means the price has increased for this company, and how many percent. If it's negative, means the price has reduced from yesterday. Correct? Sometimes there are after hours, like the stock exchange is closed at 3 o'clock, they are still trading outside the stock exchange, right? So those are also again input into here, that after the stock exchange was closed, the trading was continued and the price was 60.42 at that point of time. Then there is a range. Here you will see the range and 52 weeks. It's just telling you 52 week means what is the price has changed in the last 1 year, what is the lowest and what is the highest. So in this case, it's $42 was the lowest price and $66 is the highest price. And open means today. At today, the stock was open for trading at 60.42 and the volume today has been 6 million shares. Those have been sold over a period of time. So you can see here the remaining 8 shares, right? 893 millions. So there are total 893 million shares in the market open, available for sale, but only 5 millions are being sold. Means the trading is happening only 5 million. The rest of the shares are held by the company. They are not selling, they are not buying anything. As I said, not every share is sold and in the market, because the majority is held by few individuals who don't want to sell their shares because they are the owners of the company, right? They will not sell their shares just like this. Then this is the market cap. Market cap means what is the total worth of this company in the market. So that is normally the number of shares outstanding multiplied by the number of share price. So it becomes $53 billion. That's the price. Then you have earning per share. How much the share earning in the last year? So the company has been earning only $2.52, but their share price is $60. What does mean is you have to pay $60 today in order to get an earning of $2.52 in a year. So now you can calculate how many percent is the earning. Basically, they don't show the dividend because dividend depends on the company to pay or not to pay, right? So the better measure is earning per share because that's the value the company has created for you over the period of year. So if it's 2.52 divided by $60, that's your annual earning, maybe around 3% something. So then you have a beta. Beta we will understand later. And the investment institutional owning 67% means who are the owners. So in this case, in Nike, 67% are the institutions, means they are not retail investors, they are not individual people, they are some big companies who own 67% of Nike, but the rest of the 33% is sold to retail investors, means those who are buying and selling on a daily basis, or they just keep for their personal investment and all those kind of things. So let's understand also the common stock. Two type of shares. One is common stock, one is preferred stock. So the common stock is have two major things that we need to understand here is shareholders voting rights and shareholders rights. What are the main rights of shareholders apart from getting the dividend, right? So the main shareholder voting, how does shareholder voting happen? So let's imagine there are 100,000 shareholders in the company, right? They own the shares and everybody owns some portion with small portion. Somebody owns 10%, somebody owns 1%, somebody owns 0.1%, depending on how many shares they hold, but total is 100,000 and no one owns more than 50%. So how the business of the company will run? Who will run the business of the company? Is it the largest shareholder who may be owning, let's say 20% or 30% of the company, or everybody together who even own 1% of the company? So what do you think? How the business of the company should run? So what happens is the companies are run on a diplomatic way. Means diplomatic way means they do the meeting together and they nominate few people to run the company, whether it can be a shareholder or it can be somebody else, right? And then what they do is they do a voting. Say, okay, everybody of all 100,000, the straight voting means like straight is one person, one vote. Whether he hold 10% shares or he hold 1% shares, is gonna be one vote, everybody. So that's the way of voting. Another way of voting is on based on the number of shares they hold. If I hold 10%, I'm able to vote 10, and if somebody owns 1%, he is able to own only 1, right? So that's the way. So they vote, and whoever gets the highest vote wins it. That's the way the companies are run. So first they identify who will manage the company, so they will become board of directors. So you might have board of directors in your companies. Board of directors are usually chosen by shareholders in an annual meeting. So that's their right to do, right? There has to be an annual meeting where the shareholders are normally going to appoint or remove the board of directors based on their performance over a period of 1 year. In the annual meeting, they will be discussing the financial performance of the company. The directors will explain to them what happened, what are our plans, what are we going to do in the future, what do we do, where the business is coming from, what was the profitability and everything. If shareholders are happy, they will reappoint the directors. If shareholders are not happy, they will remove them and add new ones, right? So that usually happens. So the shareholders' biggest right is to vote in their annual meeting. Or shareholders, if they want, they can anytime do a meeting by themselves. That is normally called extraordinary general meeting, right? In which they can decide again whether we need to have a new directors or not, right? So that's the way. And normally the different type of voting, as you will see, is the straight voting means just number of votings. The cumulative voting means that they will choose the option and they say, okay, this is my first vote, my first vote goes to this, second vote goes to this, third vote goes to this. And then the accountants will accumulate all the first votes to certain peoples, and then they will see, okay, who wins or who is not winning. Then there are classes of stock. Even in the common stock, there are certain class A, class B, class C shares where they hold different rights. So normally the class A shares are the voting shareholders. There are certain classes of common stock which is not entitled for doing a vote. So their share price are slightly cheaper than those who are having a voting rights. So for example, if you have heard of news, Facebook, for example, right? Mark Zuckerberg, he owns only 20% of the entire company. I think not more than that. But the shareholding, the voting rights of his voting rights are more than 50%. Why? Because he has the highest class of the shares. The other class of the shareholders, they are there, they are the owner of the company, but they are not entitled to vote because they bought cheaper shares. So that's why he still controls the company, even though he is not the single largest shareholder of the company. That's why the shareholders cannot remove him from the chairmanship or from the board of directors, even if they want to do it. Everybody is against, but they still cannot do anything because he holds the highest voting rights. So that's how the shareholder voting rights work. And then there is another right called proxy. The shareholders, because there are so many and sometimes are they very small, so what they can do is they can say, okay, I assign you to be my proxy. So they can assign somebody else, one of their shareholders, as a proxy to say you will vote on my behalf. So normally what happens is the smaller shareholders, they join together and appoint one person as a leader, like a union, right? So you can think of proxy as a small union within the shareholders, and they say, okay, these are my proxy, these are my representative. Then among the small shareholders, they become powerful because they are now accumulated votings of, let's say, maybe 5% or 10% or whatever. So proxies are another way of shareholding so that your power is concentrated, right? That's the common stock. Then you have preferred stocks. So what happens with the preferred stock is there is not much of difference between the preferred stock. The only thing is they are similar in the nature that they have to invest in the company, they get, but the common stock are getting dividends when there is a profit. But the preferred stocks normally get the dividend no matter there is a profit or no, right? So there is a fixed amount that you have to pay to the preferred stock. So normally it depends on the terms and condition of the preferred stock. Normally there are 5%, 10% or 15% preferred stock, means they will get that much of value, that much of return every year, no matter the company is making how much profit. So that's normally a condition. And there are cumulative preferred right versus non-cumulative, means Non-cumulative means if we are not able to pay you the dividend this year, next year you won't get it. If there is a no profit this year, you still have to pay the dividend, but next year you will accumulate it to next year or next year or next year. So that's the cumulative preferred stocks. So what is your assessment? This is a kind of debt or is a equity? Still equity. The common stock is the stock where now you will ask, okay, when the shareholders can get their money back. Even if somebody, they sell on the shareholder, they sell on a stock exchange, somebody has to pay, right? So somebody, it's not a company. So normally the shareholders cannot get back their money in the company lifetime unless the company decide to buy back. But company also cannot buy back 100% of the shares, right? I mean, there has to be one shareholder at least in the company to continue and survive. So that shareholder can back their money only when the company decides to shut down their operation and they say we sell everything, and then whatever is left we pay all our liabilities. The first, normally when the company decides to shut down, the common stock shareholders are the last to get any money. So first they will pay their dues, they will pay government dues, they will pay employee dues. Then the preferred stock guys will come in and say, okay, now you owe me money, you need to return me first. So their money will be returned first, and then only the whatever is the balance that will go to the common stock. So sometimes it can be more, can be less, depending on what is the liquidation value. Okay, now let's look at the how the stock normally is valued, right? How the valuation normally happens on a stock exchange. So there are a few models on how we do the discounts. The normal capital budgeting principle that I teach you is present value of future benefits should be more than the cost of investing into the project, right? That's only then we will do the investment, correct? So the same you can apply to the stock. Now what happens in the stock is, what is your cost? The price that you pay today, right? And what is the benefit that you are getting from buying the stock? You are going to get the dividends in the future, right? The share of the profits, or the company, whatever the company is earning, that share when it comes to you, then that should be higher than the price that you are paying today. And then only you will invest into the stock. So that becomes the basis of pricing the shares. Now it depends on what is the history of the share, the dividend they have been paying, and what is the future opportunity for the company to pay the dividends in the future. That will determine at what is the maximum price we are willing to pay for that particular share. So the dividend, you can divide them into like a 1 year investor. Means that 1 year investor will say, okay, I buy the share now, I will get the dividend at the end of the year, and then I will sell back my shares at certain price, right? So there are two potential sources of income, cash flow from the owning a stock. One is the dividend, which is share of profits that the company is distributing every year to their shareholders. So company is making money. Company say, okay, now I made $100,000. Let me keep $10,000 for my reinvestment or $20,000 for my future projects. The rest of $80,000, which is extra, I will return to the shareholders because they need to get some income for investing into the company, right? And if let's say you are only 1 year investor, then at the end of the 1 year you will sell your shares and get some cash again, right? So in that case you will be discounting them at certain rates, right? So we will learn the equity cost of capital in later stage, but for the time being you can make it equal to your cost of capital or your interest rate, right? So what is the formula? So formula for that will become your cost of investment should be equal to the present value of dividend, which you will get at the end of year 1, and the selling price of your share, which also you will get at the end of 1. And if you remember, the formula for calculating the NPV for the first year was what? Cash flow divided by 1 plus R, right? So this formula you can split into two: dividend divided by 1 plus R plus P, selling the shares at the end of year 1, divided by 1 plus R. So that is the maximum price you want to pay today. Otherwise, you will be making loss, right? So that's one way of doing a valuation of share. How much you want to pay for that particular share based on the investment, right? 1 year investor. Then there are usually other investors as well. So there is a dividend yield. there are capital gains and there is a total return. That's the dividend yield will be actually the return. If you want to calculate the yield of different yields, what will be the yields? So the what is return on equity, right? So you can turn this formula into the 1 plus RE equals dividend plus the price divided by P0, correct? P0 equals dividend 1 plus P1 divided by 1 plus RE. So if let's say I switch the formula to say 1 plus RE equals dividend plus P divided by P0, that will be okay, right? Okay to say, correct? Mathematically okay, right? If you mathematically change this formula to 1 plus RE equals dividend 1 divided by P0 plus P1 divided by P0, correct? It's the same thing. So the dividend 1 divided by, so it will look like this. It would look like this, right? RE equals dividend divided by plus P divided by P0 minus 1, correct? So dividend 1 divided by P0, it's your dividend yield. What is the dividend yield means? How much dividend you are getting for the price that you are paying today, right? How many percent? Plus, what is the profit that you are making? P1 minus future price minus the present price divided by the present price. So that is your capital gain yield, right? Capital gain rate based on the current price, right? Return of equity is basically equal to the total return is equal to dividend yield plus the capital gain, basically. If you don't want to sell or you have never got to sell the share because you want to invest for a super long period of time, what will happen? You will not get this capital gain, right? Because you are not selling. You will get only the dividend divided by dividend yield. Your investment, your price will be dividend divided by the RE, your estimated or required rate of return. How much you want to get in terms of like percentage every year, and the dividend will be divided by that price, and then you will get your estimate price that you want to invest into the share. Let's look at an example, then it will be easier for you to understand. Suppose there is a stock, Long's Drug Store, to pay an annual dividend of 0.56 per share in the coming year and to trade at 45.5 per share at the end of the year. If the investments with the equivalent risk are giving a return of 6.8%, what is the value that you want to pay today for long stock? How will you work out? 0.56 plus 45.5 divided by 1 plus 0.68, correct? Or 0.068, 6.8%. How will you turn it to decimal? 0.068, 43.13, yes. So the price that you want to pay today is 43.13, right? Now you are getting a dividend of 0.56 on 43.13. So what is your dividend yield? So dividend yield will be 0.56 divided by 43.13, which is 1.3%. And the expected capital gain is, your future price is 45.5, your current price is 43, you are making capital gain of 2.37. So that is per share, you are making around 5.5%, or in a total of 5.5 plus 1.3, that becomes to 6.8%, at which we actually did the discounting, right? So that's how it works. Is there any question on this? Is there anything which is not clear? That's another concept that we will be learning very soon, is how this interest rate is, because at the moment we are discounting based on 6.8%, right? So how this 6.8% is determined? It's usually determined by adding the bank interest rate plus a risk premium. So that we will discussing in future. There are two things to understand. One is the pricing model, means how do we value a stock based on a very simple understanding that we are going to get a dividend and we are going to get a capital gain in the future. So this is the price. So the price that you need to pay today for a share who is paying a dividend of 0.56 and will be getting you back $45, you want to pay a maximum of $43.13 for this price if your required rate of return is 6.8%. Now if you are able to buy this share at lower than 43, you will be very happy to buy it. If you are getting to buy this share at a higher price, 43.14 or 43.2, then you should not be buying this, because in that case you are not getting your required rate of return, right? Because which is 6.8%. Now this 6.8% is divided into two parts. One is dividend that you are getting. So dividend you are getting is 0.56, and the capital gain that you are making. So capital gain you are making is 45 minus 43, 2.37. So you are making 1.3% in dividend and 5.5% in capital gains. So that's how it's supposed to be understood. Key concept here is the two. One is dividend yield, one is the pricing. That's one thing is in this example, okay, the price is given already, right? The future price you will not be able to gauge from any perspective. You will have to estimate the price, future price. Let's say in a real world now, let's say for example, we go back to the real world and say, hey, we want to buy the Apple share. Now, what is the price of Apple in the market at the moment? Now is $131 for one share, right? At the moment. So, and let's say I want to make a 5% return on the stock. So if let's say assume Apple is not giving you any kind of dividend, right? Let's make it simple. So the only way to buy this share is if and only if the future price of the Apple would be more than 5% of $131, correct? Now you need to understand what is the future price, how you are going to determine the future price. There is no way, nobody is gonna tell you how much is the future price of the stock. That you have to gauge by yourself. That's where the difference in the opinions or differences in the valuation comes from. Everybody has their own information, right? If let's say you are internal executive of Apple, you know what is their plan, you know what is their profitability, you know what they are doing in the next year. So you will have some idea of how much would be the income that they will be getting. If everything goes same, then the future price of the share will be increased by X amount because of the earnings, right? We will be learning that model, how we ideal scenario, how the price should move, right, based on the earnings of the company. So the price of the share should move based on the earnings of the company, how much the company is expected to earn. The share price in an ideal market will be increased by similar percentage, because everybody has the same knowledge. Assuming everybody has the same knowledge, everybody know what is the profitability, everybody is working on a rational basis, not because I like Apple, that's why I want to buy the Apple at whatever cost, correct? Or not because I want to sell the share at whatever price I can get because I need money, because there is some emergency in my home. But in the real world, the stock market works in a different way. So it's very hard to estimate the price in the future. So you will not be able to estimate the price in the future reliably. You can just only make estimates only. So based on that, you will make your pricing. But these are all estimates. Now, whatever we are learning here has nothing to do with the real world. It's all estimates. It's the game of estimates. In this equation, there is nothing certain, right? What is certain is 0.56 dividend, which you think you will get in after 1 year. It's not certain, correct? It's an estimate. The price that will be after 1 year, it's not a certain amount. It's just an estimate amount. The 1.068, the price, the return on the equity by which you are discounting, it's also an assumption, right? This is an assumption that investors would be happy with 6.8%. In reality, it may be different. So don't try to find a logic in these things. There is some understanding, some adjustments, some assumptions that we have to make for future, because we are now discussing the future prices, future dividends. It is possible. It is done by many investors, but as you said, the future is unpredictable, right? So the past performance is not really estimate of the future. So what they do normally is they learn the past and they try to estimate the future based on that. Not exactly like a trend analysis, no? That okay, if it's growing by 10% every year, I will adjust the 10. I will increase by 10%. So there are two types of analysis. One is the technical analysis based on the history, based on the chart. What is the trend line saying? How much should be the price of the stock, right? When it should fall, depending on the history in the past. And then there is additional information, the fundamental information, that is the company has enough orders in the future, what is the general plan of the company, what are the government policies about this particular industry, or what is happening. For example, now in coronavirus times, the pharmaceutical stocks are increasing significantly, right? And the hospitality stocks are dropping significantly. If you look at only the past year performance, you will not be able to understand why it's happening, right? Because the sentiment in the future is saying that, oh, because the coronavirus is going to go long, the pharma companies will continue to make profits, and because the vaccination will be continue to be required, the treatment medicines will continue to be required, the mask, the syringes, those all companies, their demand will continue for a long period of time. So I should buy this stock because in the future they will give us a lot of profit. But since the travel is restricted, the hotels are not going to operate in 1 year, 2 year, 10 year, and their business will go down. So the people are selling their stock like crazy. Even maybe some of them may already be even lower than their book value, because if you sell the buildings, you will get more money by compared to selling their stocks, because the stock market works based on the sentiments, based on the investors understanding where the market is going. So you cannot really use the past performance to invest into the stock exchange. No, you have to think about the future. You can use these bases to form an opinion on the long-term value of the company, right? So it's not a short-term thing, it's a long-term. If you invest for like 5 year, 10 year, 20 years down the line, then yes, some of these will be helping you to form the fundamentals. But you cannot always use these as a guiding principle to invest in a stock exchange. Then you are sure to lose money. So if you want to understand whether to invest in the stock or not, the first thing is, yes, the past performance, how they have been performing, what are they paying enough dividend, are their share price enough increasing, and then also the pestle analysis and what are their future plans. Based on those, the share prices are determined. So the variation to the dividend discount model is a multi-year investor. Now in this past example, we assume is a 1 year investor, means he is gonna buy the shares first month and then he will get one dividend and sell the shares, right? But in reality, it doesn't happen like this. In reality, there are multi-year investor, means they may hold for 2 years, they may hold for 3 years, they may hold for 4 years, they may hold for 10 years. So what will happen to them? The formula and the principle will remain the same. We will discount all the dividends that we are getting from year 1 until the year that they are selling, and discount them at certain value and calculate. So the formula will become dividend 1, right? If let's say it's a 2 year, then it's dividend 1 divided by 1 plus RE plus dividend 2 plus P2 divided by 1 plus RE square. If it's 3 years, then it will be dividend 1 plus dividend 2, dividend 1 divided by 1 plus RE, dividend 2 divided by 1 plus RE square, and then divide by plus dividend 3 divided by 1 plus RE cube plus the P3, right? So the number of the months, the number of years, it will become n. Any kind of number you put here, it will be n. So dividend n plus Pn divided by 1 plus REn. In whichever year they are selling the shares, you will get the equation up to that. So like this in example, you will see. So this is the price of the stock whenever you are selling. So you have to use the NPV method of solving this equation, right? Now, if let's say the last variation, if let's say you don't want to sell, because then you can say my shares are continue to grow, I will continue to get a dividend until a long period of time, right? And then I'm not going to sell it. So then it becomes a constant perpetual annuity, right? At some point of time, you may not be able to estimate a dividend that is going to be paid every year to a different value, right? So you may have to assume a certain growth rate in the future, and that growth rate will determine the formula for your price, saying that dividend 1 divided by RE minus G, G being the growth. If let's say you say I can estimate for first 2 years, so it will be dividend 1 divided by 1 plus RE square, 1 plus RE, then dividend 2 divided by 1 plus RE square plus dividend 3 divided by RE minus G, means the equity, the retaining minus the growth from whenever you say there will be a fixed growth in my dividends. Now this formula, if you remember, we discussed last week. That's the perpetual annuity formula based on a growth rate. So this is the example. So this is a Small Fry Inc., right, who have invented a potato chip that looks and tastes like a French fry. Given the phenomenal market response, they are reinvesting all its earning into expanding the operations, means they are not paying any dividend. So earnings are $2 per share in the past year and expected to grow at a rate of 20% per year until the year 4, right? At that point, other companies are likely to bring out competing products. Analysts think year 4, Small Fry will cut its investment and begin paying 60% of its earnings as dividend. And its growth will also be slow, and they will be earning only a 4% interest, a 4% growth. If Small Fry cost of capital is 8%, what is the value of share today? Now it will encompass all the discussions that we have made so far. So how will you solve this problem? First, you need to estimate the estimated dividend the company will pay at the end of year 4, right? So first thing is, at the moment they are earning $2. So first you have to grow first year 20%. Then on top of that 20% for year 2, year 3, year 4. Whatever is the value of that, you will say, okay, in the future 60% of this will be going to the dividend and only 40% will remain in the company. So 60% value becomes, right? And because you know the 60% will remain fixed. If the earnings increase by 4%, this 60% amount will also increase by 4%, right? So that will become your dividend discount model. So at the end of year 4, you will calculate D, which is 60% of the amount that you will get after 4 years, divide by R minus G. So R is 8%, G is 4%, right? And then you will discount that amount again to this year, current period, because it's after 4 years, not today. So first thing is, you need to estimate how much would be the income after 4 years, right? So that will be, if let's say today is $2, at the end of year 1 will be 2.4, but you are not getting dividend because you don't get any percentage. At the end of year 2 will get another 20%, so 2.88. Year 3 will get 2.46. The 20% will continue to increase until the year end, 4.15, and then after that it will increase by 4%. So let's do 5 and 6 year as well. So 5 year will be 4.31 and then 4.49, and the company will pay 60% of this. So 60% will be paid 2.49 and then 2.59 and then 2.69, right? And so this is your cash flow. Then you will do is, based on 2.49 at the end of year 4, you will calculate the value of the investment, 2.49 divided by 0.08 minus 0.04. So the price in the year 3 will become $62.2, and then you have to do it again for 62 divided by 1.08 to 3 years, because you have to discount to the current year, right? At the end of this year, the price that you want to pay for this share is about $50. So that's how the dividend discounting model works. So to summarize, there are 3 general formulas that you have to use. The one general formula is that you get a dividend, right, to a certain number of years, and then you will add the price of the shares that you think you will be able to sell in the future. If you don't know that you are going to sell the price and the dividend continue to grow at a certain percentage, then the formula to calculate the price today is div divided by RE minus G. But if there is a early growth, like in the example that we see, the growth in early years, and then after that it's a fixed amount of growth, then you can use this particular formula, right? N plus 1 divided by RE divided by N. So that's how it will be discussed. But there are limitations, right? Because in the real world, the dividends are never same and never constant, and the rate of the growth is also never constant, right? It's not the same. You cannot assume that the growth dividend will grow at 5% every year. It may go up and down like any particular year. So that's the problem with this dividend discount model, is that it's very, very uncertain. It carries a lot of uncertainty in it, because you don't know the dividend amount of the future, you don't know the price of the share in the future. So there's a quite of uncertainty. And the non-paying stocks, again, some companies, they don't pay the dividend. This formula, dividend discount model, cannot be used because, like for example, in this example that we didn't really add the first 3 years. The company was earning money, but we didn't add anything because we thought that because the company is not paying any dividend, right? So the price is undervalued. Even in the future year, we add only 60%, but actually the company is earning and reinvesting 40% of its growth. So the price that you calculate based on the dividend is grossly undervalued, right? If you are an individual investor who is interested only in dividend, then it's okay. But if you are investor who are looking to buy the company out and to operate it, then dividend discount model is not the appropriate way of doing the valuation of the stocks. Normally, there are another prospect that normally comes in the picture is sometimes the company buy back their shares, right? Because company may have extra cash. Instead of paying the dividend, they would buy back the shares. You have a choice, right? Today you pay, let's say, dividend, or you buy back the shares itself. So if you buy back the shares in the future, you don't have to pay dividend on that share because you cannot pay dividend to yourself, right? So means in the future that the base at which you have to pay the dividend will be reduced. So sometimes when the company has too much of cash, they normally go and approach the bigger shareholders and say, okay, if we buy back some smaller shareholders in the now because the market is low, what will happen in the future, because there are not many shareholders left, whatever amount, because our earning will remain the same, right? Our earnings are not going to change. The share, you buy the shares, so you pay the dividend, your future earnings are going to remain the same. But if we buy back our shares, the future outstanding amount will be less, means the same profit will be shared by less number of people. So if let's say there are 3 dacoits, right, who are going to loot the bank, if one is killed in the process, so all the dacoity that they are able to do will be distributed to 2 people instead of 3 people, right? So per person will be higher. So the value of the shareholders will increase significantly if the company is buying back its own shares. That's what normally happens. Sometimes the companies who have a lot of cash, they go into the market and buy their shares back, so that in the future per share basis will increase in the future, right? So in the dividend discount model, you had a share value, the share future sales price. So you can always add the estimate amount that the company will pay in the future the shareholder to repurchase, right? So in the dividend discount model, you can say that the present value will be future dividends per share, or the total payout will be total payout of dividends plus the repurchase divided by the